Hi, this is Scott Hamilton from InKnowVision. Thanks for watching this webcast. This is one of a series of short videos on captive insurance companies. You can view more of these videos by going to YouTube and searching for InKnowVision and captives. You can also find out more information on our website, InKnowVision.com. The website address is at the bottom of the screen. These videos are designed to be educational and are not designed to be tax advice. Please read the disclaimer on the last page of this slideshow for more information. If you have any questions or would like to explore next steps with us, feel free to reach out, contact us. The phone number and email to do that are listed on this slide and will also be listed on the last slide in this short presentation. Today we're going to be talking about a couple of tax issues about captive insurance. This tends to be a little bit more technical than we would normally get in these videos, but we want to make sure that people have a good understanding of what's happening and why it's happening, so that they understand that this is not something that's crazy or outrageous, that there are good and legitimate reasons for the tax rules to be the way that they are. For starters, what we're concerned about is setting up a captive insurance company and doing it in such a way that when you pay a premium from your business, from your operating company over to the captive, that the premium is deductible. So you have a business, you make cars, or you make car parts, or you're in a service business, maybe you're a large architectural firm or something like that, and you have to buy insurance to cover certain aspects of your business, certain business risks. We'd like to do some of that through the captive insurance company. What you want to make sure is that when you write a check for premiums to the captive, that they're deductible. You want the write-off against profits on your operating company. And in order for the premiums to be deductible, you have to do a couple different things. First of all, the insurance that you're buying should be ordinary and necessary to your business. Now, how do you do that? Well, you just make sure that the risks that you're covering in your captive insurance company have application to your business. So, for example, you might say you have a business in Florida, you've got facilities there, you've got buildings, you've got equipment, so forth and so on. And of course, in Florida, one of the risks that business owners are susceptible there to are hurricanes. More importantly, they're susceptible to flooding. So if your business is in a big warehouse and you're on the ground floor and a big hurricane comes through, it's entirely possible that you're going to see flood damage. So that's something that you might consider covering. And that would, in almost every case, be an ordinary and necessary type of risk to cover, and so you would get a deduction for premium that covers that. I'll give you an example of another case. This is a case where we were brought in to review an existing insurance coverage set up through a captive, and this was a company here in the Midwest where I live, and the company had a very active distribution type of business throughout the U.S., but all their distribution was in the U.S. All their sales execs, all their key employees were in the U.S., in fact, many of them in the Midwest. And one of the coverages they had was for kidnap and ransom in foreign countries. Now, that could be a legitimate type of coverage for some businesses, but not for this business. They didn't have any exposure to kidnap and ransom for their executives while they were doing business out of the country, because they never went out of the country. So in that particular case, you could see why that might not be an ordinary and necessary type of a risk to cover. And so you want to be careful about that. But again, that really comes to the underwriting. When you start out a program like this, you're going to be working with an underwriter who's going to look at your business and identify the key risks that are applicable to your business, so that the coverage is related to the types of risks that you face. Now, the other thing that you have to have in order to be deductible is you have to have real insurance. So there's two components to that. There's risk sharing and there's risk shifting, and we're going to talk about those next. The first one is risk sharing, and this one's relatively easy to think about. What we want to do here is the service is saying, or the rules are saying, that if the only business you're insuring is your own business, then you don't have risk sharing. What you simply have is self-insurance. So in order to have real insurance, you have to have some risk that the captive is insuring that's not related to your particular business. Now, there are a number of different ways to do this and a number of different tests. We typically use what's called a safe harbor test, which is based on a revenue ruling from the IRS from 1989, when they basically said that if you have at least 51%, it says 50% here, but it's at least 50%, so that means 51% of unrelated risk, then you meet the safe harbor test for the service. Now, it's unlikely that we're going to expect a business owner to go out and try and find other businesses who might want to get insurance with their captive. Most business owners don't have the time or the expertise for doing that, and the captive managers, captive insurance company managers know that. So typically what they do to facilitate this is they pool together in a reinsurance pool all of the other business owners that they are acting as captive managers for, and they basically reinsure the risk of all those business owners in the pool, and they share that risk out to your captive as well as to all the other captives. And in that way, you meet the test of risk sharing. You'll be insuring your own business for 49% of the risk, and the other 51% of the risk of your business will be covered in the pool, and that's true for all the other business owners. If you have questions about pooling, because even though it's a relatively simple concept, it can get fairly complex in the execution. Again, give a call. We can talk through the issues and talk about why business owners are comfortable participating in pools of reinsurance. The other thing that you need to have in addition to sharing is risk shifting. You actually have to move a risk off your balance sheet, your business's balance sheet, and onto the balance sheet of the captive. Now this, of course, is what insurance is all about, and this is relatively simple to accomplish. Basically, if you pay the premium and you agree with the insurance company that whatever the risk is, maybe it's a flood risk or it's maybe it's a hurricane risk, the insurance company is basically, your captive insurance company is basically saying, we're taking on that risk now. If you have an event and you have a claim and you make that claim, we'll pay the damages claim up to policy limits, of course, not over policy limits. So you've effectively shifted some or all of that risk off your balance sheet onto the balance sheet of the captive. Okay, the last thing we want to talk about here is the 831B election. This is, of course, something that has been getting a lot of attention lately as people start to look more seriously at captive insurance companies. The 831B election essentially says that when a premium comes into a captive insurance company, that the premium income is not taxable to the captive insurance company. So if you're sort of following the flow here, what you're getting is your operating company gets a deduction, let's just say a premium of $1 million, so that saves you taxes at your operating company level. And the captive insurance company receives $1 million, but it doesn't have to pay tax on that money. So this is a pretty good deal, and it's often one of the things that business owners focus on. I don't know that it should be the only thing they focus on, but it's certainly one of the things that they focus on. And they think, wow, this is a pretty good deal. I think what business owners and possibly a large part of the population that cares fails to consider is that this is just the way all insurance companies are taxed. And the reason that they're taxed this way is because the money coming into the captive, in effect, is not profit. It's really reserve money. It's really money that's set aside to pay claims that might arise during the year. And so for a large insurance company, they do exactly the same thing. They'd have a more detailed calculation as to how they calculate reserves. So they'll hire an actuarial firm and they'll say to the actuarial firm, we want you to figure out of every premium dollar how much of this is going to be reserve, how much is going to go to expenses, and then how much is going to be profit. And that's just a projection. It's fairly complex. It's fairly expensive to do. What Congress has decided is that for small insurance companies, they're not going to put them through that kind of rigmarole. They're basically going to say that if you have premium income that's no more than $1.2 million in a year, you can elect to be treated as a small insurance company. All of your premium income will be treated as reserves, therefore not taxable. And of course, to the extent that you have claims, you're going to have to pay that money out. So you can sort of see why this all makes sense. It's really just a cost-saving feature for small insurance companies, but it is what allows premiums of up to $1.2 million to come into the captive a year without any tax. So hopefully that's been helpful in terms of understanding how the deduction side works and how the income tax side works on the captive insurance company. Uh, of course, there may be other questions that I haven't addressed. I'm always assuming that there are. If you have those kind of questions, if you'd like to talk to us about whether or not this is a good fit for you or for your company, give us a call. The number is here. Email is also a great way of reaching us. And if you're just interested in getting some more information about captives, feel free to go to the YouTube site. We've got the link here. Or again, you can just go to the search box at YouTube and type in InKnowVision, and captives will bring up more videos for you to watch. If you have any input on those, we'd love to hear it. And again, thanks very much for your time. Look forward to getting a chance to speak with you about whether or not this might be a good fit for you and your company. Thank you.